I'm joined by Dr. KV Subramanian of the IMF here. Thank you so much for speaking to us, sir. You've set an ambitious target of 55 trillion for 2047. I want you to speak about that and also a bit about the two caveats that you've also mentioned along with that target, and also with the context of India being the sort of island of calm amid the global turmoil you're seeing.
So if we look at historical episodes of growth, if we use Japan as an example, from the period from 1970 to 1995, Japan's GDP was $215 billion in 1970. It had grown by about 25 times by 1995, to 5.1 trillion. GDP per capita had increased from about $2,100 to about $44,000. This was during a period where the inflation in Japan declined from about 8% to 1%, resulting in a lowering of interest rates as well, and importantly, significant currency appreciation from 350 yen to the dollar in 1970 to 85 yen to the dollar, in 1995. So in the estimation that I have made, I have not even assumed any appreciation of the currency. I have, and for good reason, projected that given the inflation targeting regime that has been implemented in 2016, which has significantly lowered inflation from about 7% plus to 5%, and that will translate one for one into a lower rate of depreciation. So compared to the average depreciation of 3 to 3.5%, which prevailed when inflation was 7% plus, depreciation should be lower by at least 2%. So about 1% rate of depreciation. This is ignoring any real appreciation, which also I've actually modeled. So even if we don't assume any real appreciation, the rate of depreciation of the rupee will be lower. And when you add that with the power of compounding, and that is actually something that is really important to keep in mind. So if we have 8% growth in real rupee terms, in real terms, rupee, 5% inflation, that's basically 8 plus 5, 13% in nominal rupee terms. You have to subtract the rate of depreciation because depreciation reduces the value in dollars compared to rupees. So if you assume 1% rate of depreciation, 13 minus 1 is 12%. So that's basically 12% dollar growth, in the course of the next 2.5 decades. So over the 24-year period from 2023 to 2047, that translates into doubling of 4 times. Why? Because if you use the rule of 72, which tells you the number of years it takes to double, 72 divided by 12% in dollar terms is 6 years. So every 6 years GDP will double. That's 4 times doubling. India's GDP in 2023 was 3.28 trillion. Let's approximate it to 3.25. From 3.25 to 6.5 to 13 to 26, and finally to 52. That's close to the 55 trillion number. It's also important, actually, in the discussion today, Dr. Arvind Panagare also highlighted that if you look at the last 20-year period, we've grown in dollar terms at 10%, and that was actually, in a period where the rate of depreciation has been significantly higher. If you add 2.5% to that, actually you get the 12.5%, 12.5% that we really need. So I think I actually believe that this estimation, which seems audacious, but actually is indeed achievable if you think carefully, by removing some of the blinkers that many of us have, and take into account, sound economic arguments and the past performance. So if you allow, I would use this example from cricket. In the early 90s, when Sachin had just played a few years of cricket, his performance was demonstrating his potential. Sunil Gavaskar had said that he expected him to score at least 40 international hundreds and 12,000 international runs. That was the potential. That's where I think, given past performance, that's where Indian economy looks. But at the same time, it is equally critical to mention that Sachin did not score 100 international hundreds and 15,000 plus runs just based on potential. He worked hard as well and overcame setbacks like the tennis elbow, for instance. Creatively thinking about how to overcome setbacks. There's an important lesson there as well for India, that we need to work hard. And here, actually, I will put the emphasis on states in particular. A lot of the reforms, need to be done by states, and especially channels like yours, I think, need to ask pertinent questions of states. All of us actually oftentimes put the focus on the central government, which actually should be done. I have no problem with that, but I think we do not ask enough questions of states in being able to do reforms. Many of these reforms that need to be done, whether it's land markets, whether it's labor, these are basically states need to do. And I think, people like you need to ask questions of the state chief ministers about what are the reforms they're doing in order to basically fructify India at 100. I think I would urge all, through using this channel, not only you but all other media, to ask questions, actually irrespective of which party is in power in the states. Basically, what are they doing on these reforms? That's what equivalent of what Sachin did to work hard, and our states and the center need to do to be able to actually fructify this goal of $55 trillion economy, which I think is achievable by 2047.
Got it. Very interesting points there, Dr. Subramanian. One question more that I have is there's a lot of chatter on the fear of household funds entering a lot of speculative assets in the capital markets. Do you see that as some sort of a threat to growth?
See, I think while it's important to always monitor this aspect, as a financial economist, I've always believed that that every financial market, if it has to be liquid, it has to have a reasonable mix of both fundamental trading driven by fundamentals and trading driven by some speculation. I think what is critical here is to make people, especially retail investors, aware of the risks and make sure that they have the necessary capabilities to be able to take these risks. But I think institutional sector activity that basically is leads to more liquidity. You cannot have liquidity if you only have long run, only have investors investing based on long run, fundamentals. You have liquidity required a good mix between. I think this is something which, as a financial economist, I keep emphasizing. The emphasis needs to be on ensuring that retail investors understand what they're getting into. I'll give you the example. My first job out of IMC was at ICICI, and I used to be part of the derivatives research group. I can share. Derivatives is not an area that actually where people can understand very well. It actually, if you have to be able to model the pricing and do pricing of derivatives, you need to understand stochastic calculus very well. And leave alone a stochastic calculus, even calculus oftentimes actually is hard enough. So these are aspects that our investors need to understand, that you don't want to be in a situation where you're the fish in a ocean basically full of bigger animals. So but that said, I think I will reiterate that one cannot choose the extreme of no speculative activity at all. I think that's important for a liquid market.
Right, fair enough. One quick question on we're seeing a flip-flop in the indexation benefits in real estate now. There's been a new finance bill with amendments rolled out today. What's your take on that?
I think overall, rationalization that enables, ease of doing business, and especially from the tax perspective, because tax is a critical element of ease of doing business, is something that I think, and that's, as I said, I emphasize that it will really help in, pushing further business activity, and, also will generate employment in that process. And I think this is important, especially, here many times some of our demagogues choose to focus on corporate activity as if it is substitute for employment. But the simple fact remains that if you take any business for that matter, whether it's actually the shareholder returns that they generate, they basically go to shareholders who are eventually investors. And even the salaries they pay to employees, those basically both of them go and either spend in the economy or save, which is also then used for economic activity. Equivalently, whatever retained surpluses that they have, they plow it back. That is basically something they're not putting as rupee bills in their mattresses. They're employing it for in factories, companies that that generate employment. So I think it is important to understand, and the reason oftentimes demagogues get away by sort of portraying in this binary manner is because of the nuanced understanding of the complementarity between wealth creation, and employment, and in fact inclusive growth is oftentimes not understood very well. So again, I think it's important for such things to be understood. So we have to sort of focus on understanding some of these nuances, and that's the way I would portray this.
Thank you.